All right. We are back with another episode of the Real Estate Investing Club. Hope you guys are having a great week. Great Friday. As always on the podcast, we do our podcast recordings on Friday, and it is a nice and sunny day here in Seattle. So I'm excited about that. I'm really excited to go out and actually experience the outdoors this weekend. Man, it's been 6 months since I've done that. So it's going to be a good day. It's a good day for a second reason because we have Lane Kawaoka on the show with us from beautiful Hawaii. He is with the Wealth Elevator, and he has tons of experience to go into. So I'm excited to jump into this. Lane, thanks for hopping on.
Yeah, thanks for having me. Aloha, everybody.
Absolutely. Before we go into the meat of it, we always like to start with stories. We like to hear how people got to where they are. Why don't you take us to the beginning of your story and tell us how you got here?
Yeah, so I was on this linear path, like go to school, study hard, became an engineer, went to University of Washington out there in Seattle, started to work for the man and, just kind of blindly followed the put your money in the 401k nonsense and buy a house to live in. So after a few years, I saved up 80 grand to buy a house up there in Maple Leaf, North Seattle.
Oh, nice.
And
80,000. Nice.
yeah, well, I think it was like 350 was the purchase price, right? So 20% down payment.
Hmm.
And young 20-year-old kid had a house to himself, essentially. But because I was working for the railroad back then, I was traveling all over for work and never home, only home on Saturday. So I just decided on a whim to just rent it out. And that was the start of this crazy journey for me. Started to realize like, wow, this is powerful stuff. And, bought another duplex out in South Seattle after that. Started to learn, maybe you shouldn't buy luxury properties that you want to live in. I think maybe you've kind of gone that direction with the mobile home parks too.
Yeah.
But then started to realize like, places like California, Hawaii, Seattle just aren't going to have the rent to value ratios to be able to, make any cash flow. So I started to buy about 11 properties in Atlanta, Birmingham, Indianapolis.
Oh, nice.
And, that was around 2015. So I went as a remote turnkey investor from 2009 to 2015. And then that was kind of the second big pivot when I went into syndications and private placements from there when I realized that the little single family homes just weren't scalable when I became an accredited investor.
Yeah. Yeah. And that is kind of how the trajectory goes for a lot of investors is they kind of jump, land into it, not intentionally, but maybe they buy like you did, they buy the single family house. They're like, I can rent out this room or I can rent it out when I'm not here. And then they realize like, holy crap, there's income coming into me every month. This is a great, this is a great strategy. Maybe I should turn this into a business. And so you went from single family to duplex, and then you bought some throughout the country. You were looking in, lower price point markets. At what point did you actually make the switch to the syndication side?
Let's say 2016, we started to get into that type of stuff. Paid a lot of money for all these like group courses and classes and, physical groups, right? And I don't know if it was worth the money, but I mean, I learned how to underwrite the apartment deals out of, those times. But I realized like unless you live where the deals are at, it's just probably better to just be a passive investor. But because I was like doing this podcast back then, I had built up an audience of, single family home remote investors.
Mm.
And we were all kind of growing into the same direction of being accredited investors. And about the same time, I mean, this was just like a cornucopia year, like 2016 for me was when I started to interact with other accredited investors. And this is kind of where I realized and I learned, kind of put together this curriculum that accredited investors follow, which is, invest in alternative investments, whether that's rental properties when you're getting started or larger deals when you're more accredited, combo with the passive activity losses, AGI manipulation on the tax side, and then infinite banking in this trifecta, super powerful. And, I didn't read it in a book. I had to get it from other accredited investors. But the problem for me is like my parents never owned rental properties. I didn't have a rich uncle. I didn't know anybody who was accredited. And I just started to piece this all together as, best practices from all these people I was sort of meeting as informal mentors. And, that was, yeah. So we started to, syndicate little 50 unit Class C properties. I mean, it's where everybody starts because you got it because you can't raise capital for crap, and that's all you're stuck with. Um, you can make good money doing that, right? And it was a good market for sure.
Mhm.
But like some of those properties, like 80% of the tenants paid their rent, 80% collections, and that's just how it is in that Class C clientele. Move
Yeah,
up
and
to
having
more
to deal with
class.
evictions and people trashing units, doing turnovers, all that stuff can be very can be a headache if you don't have the right property manager in place.
Yeah, yeah, but it is kind of it is what it is in that rung of properties and tenant classes. I mean, eventually moved up to a little bit class bigger properties, more class B, started to develop, right? Because developing, to get the loans for that, you need to have a better resume, right? So I think what we started to realize is a lot of people who just bought some rentals and thought they could buy a 300 unit apartment complex were competing with us on the bidding table, pushing prices up.
Mm.
So we started to kind of move elsewhere. Obviously, we felt the effects. We got established before the year 2000. I think 2000 we went over $1 billion of assets owned,
Oh wow!
and
Wait, in
after
the year 2000?
yeah, sorry, 2000, yeah, 2020,
Oh,
yeah,
okay, okay,
2020, yeah,
nice.
yeah. So that was kind of a year where we started to kind of take ourselves out of the business, hire asset managers to kind of play that rung, that first line of defense to operate the property managers.
Hmm.
And I think this is a big differential that I never realized initially. Like, yeah, you can run some single family homes by yourself, maybe some small apartments, but unless you grew up in the business, right, you were a property manager for 10 years and, went through this. There's a lot of lessons learned going through it where just you can't just be an entrepreneur and do it.
Yeah.
Um, so that's we went through the ups and downs of the 2021 to 2023. Since then, commercial real estate has come down 20 to 30% in the commercial and office space. We got hurt too, just like anybody else. If they don't cite it, they're lying. Um, and these days we actually also look at private equity deals, things outside of real estate, because my long-term thesis, if you look at, I mean, look, this is the Real Estate Investing Club. I'm a real estate fanboy too, man. I will always invest in real estate. But if you look at where the Chatham financial curve is, I mean, everybody should have that page bookmark. The Chatham financial curve. These are the insurance rate cap providers. They're the guys who have skin in the game and predict where the interest rates are going. They're
Hmm.
not predicting the Fed rate to come under 3.5%, maybe in the next decade. So
Oh,
the
really?
era of interest-free money is gone.
Huh.
I was lucky to ride that wave from 2009 to 2022, summer 2022.
Hmm.
So
Yeah, we have a loan. Our lowest loan is it's 3.1%, and it's just like when that's never going to happen again.
yeah, I mean, it's all speculation, but I want to be a realist here. Like that, the real estate's good because it's slow and steady. But the bad thing is it's slow and steady. So you have to use leverage in real estate, especially to get, yields that people want. But you need to combo it with the right capital markets, which is the loans, right? So it used to be you would get 75% loan to value. Today, that's maybe down to the 50s. And that is driven by the 10-year treasury, which is driven by the Fed rate. And we're not seeing that rate coming down, even under two, I mean, even 2%. I don't think that that's going to happen. So long story short, we just lost a big trade win behind our backs for the whole real estate thesis.
Hmm.
So, I mean, we've been kind of going back to the drawing board ourselves. Maybe we just start private money lending on house flips, or, we're still, I mean, yeah, sure. If you can find a property undervalued by 20, 30%, then yeah, that obviously is going to make a deal and it's deal specific. But, this is kind of why we've kind of opened things up to buying businesses, doing
Hmm.
things a little bit outside of real estate. But yeah, I think that's kind of what long story short, that's what we've been doing these days. But I wrote a book, right? The Wealth Elevator, and I think it kind of chronicles this like based on where you are at,
In
these are the
the
steps that
chain.
I've kind of gone through over this last decade plus.
Yeah. Yeah, that's really interesting. So you guys have you've gone through the syndication phase, you've built your portfolio, did you guys sell off your portfolio, your real estate portfolio, or do you still have that? You still have your asset managers in place and everything's kind of cooking?
Yeah, I mean, we'll continue to do it, right? Because that's our business. But, through this journey, I've met people on that next level, right? People on the penthouse level and beyond, and that I code name in the Wealth Elevator book, your what family offices.
Mm,
And I think that's important. And I wish I had when I, just buying little single family homes is what are the people doing on the next level up? And
yeah.
also the next level up beyond that, because it helps me
Hmm.
cut corners along the way. And when we buy these apartments from very wealthy people, right? These family office type of people, or even the people a little bit below that, right? Your 10 to $100 million net worth families that you people never hear about. You never know who they are. But working with them on transactions, you start to realize, I mean, who these people are, and there's a lot of them. And then also, what is their mindset and what are they doing, right? And this kind of helped me personally as an investor myself, kind of battling with them on transactions, buying properties from them and negotiating. You start to learn about like what's the next level, right? Because
Yeah.
eventually we buy these apartments, we're going to be them. Hopefully not on our deathbed, like how some of them are, but you start to understand like, all right, there's pieces and levels to this journey, and that's kind of why it took me a while, but I came up with this construct of like a building, right? You have different floors of the building, and the wealth elevator is meant to kind of expedite you through the process, so you don't have to take the freaking stairs and do it the slow way, like how I did it, without any mentor. I mean, there's a lot of books out there written for the broke guys out there, Dave Ramsey, Susie Orman, right? If you're in credit card debt, you make under $50,000 a year, you probably shouldn't be living in Seattle, right? Obviously. But that's in the basement level of the wealth elevator, right? So it's at least it's the term is coined there. The first floor of the wealth elevator is for guys who are not accredited, but have decent incomes. That's kind of where I started out of college, right? And you buy rental properties until you get to accredited investor status or your income surpasses $200,000 a year. Then you get to the second floor of the wealth elevator where
And
you start to buy.
200,000, that has to be kind of location specific because 200,000 in Seattle, that is not a lot of money. But 200,000 in, Dayton, Ohio, that's a significant income. So that has to be kind of a very loose, level to this elevator concept you're talking about.
Yeah, I think it mainly coincides with the SEC definition of accredited investor
Okay.
at that point, which is $200,000. Because a lot of investors I talk with, their net worth may not be that great, right? Because I mean, how else they're not going to be that great because they're investing in crap investments, right? But they have great incomes, maybe as a household make over 300, 350, right?
Mm-hmm.
At the least. And them buying little rental properties is just a waste of time. They're not going to do this burst strategy because they have better things to do, right? Their hourly rate at their job is more than $300 an hour.
Yeah.
They're professionals. And especially at that level, again, their net worth isn't that high yet. They're maybe even still under 500,000, but they are a target to get sued, right? And that's like rental properties are like bullet sponges for lawsuits, essentially, right?
Oh yeah.
I
You mean
mean,
like if somebody trips and breaks their leg or whatever on your property and got it.
yeah, I mean, we get sued all the time as the general partnership or the ownership LLC, where people are just trying to get the insurance policy money all the time.
Mm-hmm.
And we a lot of time like we have processes to deal with it. I mean, it happens all the time. The legal team knows what to do, but that's kind of where an individual owner that'll tear them up inside and just be so like weathering from a mental standpoint
Yeah,
to
the
be
first
dealing with
time
that thing.
we got sued was one of our mobile home parks, and I won't give any details, but it was basically a tree branch fell, and we had been doing all the right stuff. Like we had arborists go to the park, we had the trees were being cared for, but for some reason this fell, and we got sued. And that first lawsuit, yeah, it's stressful from the if you don't deal with it often, just the idea of being sued is just a stressful experience, and it's not something that you want to go through.
Yeah. I mean, at least what I've learned, I mean, I don't even know how many times it's happened, but you get your legal team involved, right? You don't wait. You just get them involved. It costs money, but that's just how it is, these things, right? Like it's just a number at the end of the day. And this is where you need to have a certain amount of scale in your operation. Like if you have, I mean, use my 11 rental properties when I had it. This is kind of dating me back in 2015. I made a few $1,000s a month, and it piles up to be what, 36, $40,000 of profit a year. Well, when you have a lawsuit, you just know you're going to have to spend 10, 20 grand on lawyers to see it through at the
Yeah.
very least, and if you're, I think, not to freak everybody out, right? Because I'm not a lawyer here. I'm not selling people's LLCs here. So, I mean, as long as you're not doing anything nefarious or you're doing what's right, you're fixing things when there's broke, which I think most people are reasonably doing out there. In clear conscience, there's not much to worry about, right? It's just going to be a dollar thing at the end of the day. Is it right? No. But look, this is what happens to all businesses. All businesses. If you haven't been sued, you probably haven't been in business long enough, right? Um,
Unfortunately, yep.
unfortunately. But look, if you can't handle it, then just be a passive investor. And, there's a reason for being an LP. And you also get exposure to so many different deals, right? You can split up your allocations and deals to, as low as maybe 50,000. 50,000 would be the bare minimum. If operators are looking to take under 50 grand, I would run away. They're just desperate for money. I mean, when you get under that level, I mean, we used to allow people at lower minimums, but they were just the worst investors.
Too worried
Call
about that
you,
money.
yeah, call you up like every other month and like ask like ridiculous questions. And it's like, no, like there's a partnership both ways here too. But um, yeah, like that's kind of how you get exposure to different geographic areas. Maybe mobile home park, throw some mobile home parks in there too, right? Some self storage, maybe some private equity. This is kind of the way that I realize on that second floor of the wealth elevator that wealthy people are starting to diversify their portfolio. And the key thing here is they're getting direct access to deals. They're not going through Wall Street and some really bloated REIT where all these institutions are getting their money first and huge hidden fees. And they're not going through some crowdfunding website where the broker dealer gets their cut arbitrarily, right? You're going and you're building a relationship with the operator and you're finding and you're diversifying your own investments and taking ownership of your own portfolio. And then it steps up to the third floor of the wealth elevator where about this time you start to hit that net worth threshold of 4 to 5 million, which I define as end game, which I think for everybody listening, even if you're in Seattle or California, it's usually a number where you want to aspire to that you can do the old 4% rule and live off of that amount and be comfortable, right? Now, I tell people, yeah, you want to get to that level and keep steadily continuing growing after that. But, depending on what your age is, if you're an older person in your 60s and your kids are adults already financially independent, not a liability for you anymore, then you may be totally fine with 3 mil as your end game number. And that puts you at the third floor of the wealth elevator already. But for most, folks and most of my clients are in their 50s, their kids aren't yet done with college. They may be paying 100 grand a year for USC, or I don't even know what, my parents are complaining about how much UW was last night. I was like, geez, it's like triple now these days,
When
guys.
I went, it was $10,000 a year, and now it's like I can't. I don't know. I think it's like 30 or something like that for in-state,
Yeah.
not for out of state. Yeah,
Yeah. I did out of state. It was like 27,000 per year, but I think it's 2x that
yeah,
today.
yeah.
Um, so yeah, that's kind of where I think like people need to like have that number, right? Like $1 million is nothing these days. And the only way you're going to get there is to invest in alternatives, put it through an infant banking plan, and be smart with your taxes and doing things well beyond 401ks and Roth IRAs and all that basic stuff.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast. So do you, real estate is obviously what we talk about here, but do you also, you mentioned buying businesses. Do you also recommend people to buy businesses before they invest in real estate? Or is that something that you generally look at after you've already been established in real estate?
Yeah, I mean, I'm not giving any tax, legal, or investment advice, but the way I did it is like I started with real estate first. So I'm a little bit slighted towards that angle.
Biased, yeah.
I feel like private equity deals are harder for people to like do due diligence on and analyze.
Unless they know they're in the industry. Like you're
right.
If you're buying a septic treatment company, then if you're in septic treatments, then yeah, sure, buy a septic business, but otherwise doesn't make sense.
Yeah. It's just like why are you buying some properties out in Memphis, right? I don't think Memphis is the greatest of areas, but maybe they live there, right? So that's their insider advantage. But all that aside, I mean, you need to be kind of looking at it as like the horse and the jockey analogy, right? Where in this analogy, the horse is the deal, right? The horse is the one freaking running. The jockey is the operator on top of it. Now, using this analogy in real estate deals, you can typically do the due diligence on the horse or like the apartment or the mobile home park, right? You can look at the P&Ls, the rent rolls, and you can typically see how it is. And in the real estate world, like we're not geniuses here, right? Like we're the dumbest guys in the investment world. Let's be frank about that. And that's what's kind of great about it, right? Your jockey or your operator doesn't need to be that amazing. Just an honest person, right? And and you don't find that until you do business with people, or at least what I found going through so many general partners myself.
You don't have to be a genius, but you do have to be, you have to be tenacious and you have to be organized and responsible. I feel like those are better qualities for a GP than being, super intelligent, because real estate is really simple, but you do have to actually do the work. And that's the thing that I found people make the biggest mistake on is they get lazy and they don't actually do the work. And so, yeah, I agree that real estate, you don't necessarily have to be a genius. Well, no, I know you don't need to be a genius, but you do have to, use basic intelligence and then apply it to real estate. You have to do the work. You have to create the processes, the systems, and get in bed with the right contractors, the right property managers. You have to have some general level of wisdom and apply it to see those results. Otherwise, you're gonna be in a world of hurt.
Right. Whereas like private equity, venture capital, angel investing, you're starting something from scratch. You're recreating the wheel. So a lot of it, I mean, you can have a really dumb idea, but if you have a good operator, CEO at the helm, it'll work.
Yeah.
Most times not, though.
Have you bought other businesses outside of real estate?
Yeah, so I mean, we've done a whole bunch of, physical businesses, virtual businesses too. Again, like this is just my method, but what I've taken from the real estate world is it's all with the people first. Where if you have honest people with a track record, that's what I'm gonna roll with, as opposed to like just beating somebody out of the blue and going with them because their numbers supposedly look good. Right. I've seen it where people fake it till they make it, till the cows come home, essentially. So a lot of these deals that we've done on the angel private equity side, I prefer private equity because there's existing P&Ls too. So there's financials backing this up.
Right.
Just like apartments, right? Like, or mobile home parks, right? You buy them and you can see the usually 2-year P&Ls to back it up, right? So it's not just a random guess what the income is and expenses are. But in these cases, like we've met the people through work, maybe they were investors of ours in the past, since maybe half of our investors these days are business owners themselves and successful ones, which is why they have surplus to invest. Go figure. And other ways is like, we've been in different, business groups and, like one of the partners we found, this is more on the real estate side, we had a contractor that was also an owner, operator, apartment owner, work on one of our properties and we built a relationship and, they inherently know other colleagues or friends of theirs, just like how we know. And when we get on that sort of level, right? When you get on, the club of $1 billion of operators and above, you get some pretty good folks that are more the operator types as opposed to like marketers out there.
Hmm.
Um, so that, taking part of that, into the world of private equity, I like to work with people who are very introverted, like maybe even socially awkward. Who knows, right? Like I want the people who operate,
Yeah.
right? And those are the people that I like, not saying I won't work with them if they aren't, but like that's kind of the target where if I want to take a shortcut finding new partnerships, that's where I start with first. But even before that, it's always referral, right? Word of mouth from my general partnership base.
Yeah. So kind of on going to your elevator concept, you've mentioned four rungs up to this point. The bottom rung, the Dave Ramsey rung, where you just have a job and you're investing a little bit in the stock market, but that's really it. And then the next run up, you're making $200,000 a year, maybe even that you bought a few properties, but you haven't, you're not living off those properties yet. And then after that, you mentioned the one that you define is the 4 to 5 million after the 200,000. And that's when you get to the point where you can live off of, if you had just taken that money, put it in the stock market and live off of that, the couple percent that's being spit back at you. That's the next rung. And then what's the fourth rung that you had mentioned?
Yeah, I would probably call this the penthouse level. I
Okay.
mean, you're good, right? You certainly aren't, you should never invest money that you can't lose.
Yeah.
That goes without saying. But certainly at this level, like even more so. And going back to your earlier question, like I think people should try and invest in real estate first because it helps you like, it's a little bit more like you can underwrite a deal and if it goes good or bad, you kind of know what it is, right? It's easier to isolate the issue and that way you become a better investor, right? Oh, when I look at the next pitch deck, I'm going to look at how long the bridge terms were for, right? In the loan, for example. But when you do private equity, there's not really any kind of correlation that you can go after the fact, right? It's more so with the person. And like I said, it's hard to do due diligence on people, on their inner workings,
Yeah.
assuming they're an honest person. So what I would say is like start with the easy stuff first, which is real estate, then go to private equity, angel investing after would be the flow. So the way that comes into the wealth elevator construct, and in the book, there's like this table kind of to outline, all these floors. But, when you have, at this point, you can you got a lead. If you use a baseball analogy, you got like a 7-run lead in the eighth inning. Go ahead and take some swings for the fences and have some fun here, right? Take some asymmetric investing. I like the idea. I personally do. I'm not giving any legal tax advice or investing advice because I'm not a certified financial planner, so I can't sell people marketable securities apparently. But I do like this idea of barbell investing, where
Oh,
you've got the two sides of the barbell, where it's obviously heavily weighted on the outside, nothing on the inside, but it's still balanced for me. But I like the idea of having a lot of life insurance. That's where the infinite banking and the accredited investor banking that we do, special twist on it. And then on the other side, more somewhat risky stuff, right? But that's where you get the outside returns from.
yeah.
And that doesn't work for most people out there. They should not do that. But for more experienced investors, that's what I see as kind of a consistent thing out there for them. So if you're a bad golfer, don't use blade irons. Just don't. You're gonna go crazy. Same thing here. Like if you're an inexperienced investor, don't do what I'm kind of saying out here. In fact, just go invest in the Vanguard 500. in ETFs. Um, but that's kind of where at this level of the wealth of you've already established yourself as an investor. You got money to lose in a way. And it's about growing your legacy. You got to get your legacy past 8 figures, which I think for most people who start at a reasonable age in their 40s, you've got a few decades to get it there. It's very doable. And like we do investor retreats, and I'm big on like getting the next generation involved because at the end of the day, once you have $4 million net worth, even three, if you have 2 kids and you give them $1.5 million, $2 million, that's probably enough. That's the point of diminishing returns, I think. Um, in fact, it's probably better to give them less than that. What's more important is give them
Yeah.
the relationships and the knowledge, and that's why we allow our members to bring in their kids to the events so they can meet other people
Yeah.
in in the ecosystem. But this is kind of where, like, unless you get your net worth to past 10 million and beyond, you're just going to it's just going to be cut from cousin to nephew to niece, and it's just going to go nowhere. If anything, you're doing a disservice to all your kids because you're just making generation two, especially generation three, spoiled rich kids. And then eventually it'll go away, right? As the saying is, 90% of wealth leaves families in 2 to 3 generations for a reason. Again, we try and create the ecosystem so that we can have the relationships and deal flow to prevent that. But, I'm not going to live forever, so I may not run the group forever. But for most people, they need to learn how to do this or take the approach that some of our members have where we're going to turn this into a real Rockefeller thing, right? It's an irrevocable trust where we're going to assume that all these Gen 2, Gen 3 kids are just going to be idiots, you know. Like I do in industrial engineering, right? We pokioki it. We make it so it's dummy proof,
Yeah.
right? They may be smart and there may be somebody in there that can, grow it, but we're going to assume that everybody's dumb and just a bunch of rich, spoiled kids who like to go on raves and just going to just blow it.
Yeah, and it's funny
No.
how easy it is. You're saying $3 million. You've thrown that out there a few times. 3 million is not. I mean, you could spend. I always like to think of like, is it a lot of money if I can spend it in a weekend? Surprisingly, you can probably spend $3 million in a weekend if you go out there. You buy yourself a car, buy yourself a, I don't know, really crazy trip. Go to the casino and spend it all. So yeah, 3 million is definitely not a lot, and but being able to safeguard that in your future generations. We had just had our first, and she's almost 2 now, which is crazy.
Oh, cool.
But instead of giving money to her in the future, teaching her how to, teach a what's the phrase, teach a fisherman how to fish or something like that. Teaching her how to actually create the value versus just giving them the money is the most important thing.
Yeah,
But hey, I just took a peek at the clock. We have run our time down, so I do have to move us on to the quick question round. Are you ready?
here we go.
All right. Starts with education. Could be any form. Could be a conference you've gone to, mentorship program you've been a part of, book you've read, movie you've seen, anything. But I need 2 recommendations: one for general life wisdom, and then one for real estate.
A general life wisdom for our work week. I think that unlocks you thinking differently off the beaten path. The next, obviously, I think The Wealth Elevator, my book. There is no
Nice.
other book that breaks out down the different stages of this wealth building journey. What got me all the time is like you hear all these like everybody listens to tips here or there from all these podcasts or TikToks or whatnot. But at what point in the journey does that make sense for that piece of advice? Because it can be horrible advice if you're on a different part of the wealth building journey. And what it comes down to is what your net worth is. And that's the first part, figuring out which floor you're at.
Yep, I love it. And if they want to get that book, they just type it in. I'm assuming in Amazon, The Wealth Elevator. It'll pop right up.
Yeah, I think we got, over 100 reviews, so you can't miss it now. And then yeah, if people, buy it and they leave a nice review and email it to us, we can cook you up with the MP3s and the PDF version too. Just email it over team@thewealthelevator.com.
Perfect. All right. Next question is for your younger self. Let's go back to the Lane who was just starting out. Maybe he bought that first the single family up here North Seattle. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would tell them not to buy 11 rental properties, maybe just buy a few and then move up to the second floor of the wealth elevator. I think that slowed me down a little bit. But then also find this guy Gabe Peterson out in Seattle and then hang out with him because apparently everybody else didn't really do much, right?
There you go. All right, next question is about the US. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
It's tough. I mean, all your normal Sunbelt states have been kind of overbuilt with the 2000 to 2023 buildup. Um, so in the short term, the next couple years, that supply is going to, come to fruition and it's going to be a little bit difficult for rents in those locations. Tertiary markets didn't have the big buildup, so maybe that, but there's not any particular one, and it's a little bit of a whack-a-mole game, so it's kind of hard to say which ones they are. Um, I think that's what excites me about private equity. It's not really about a geographic location, but it's a situation where you have a owner who's retiring or has taken it up to a certain point and they can't do it anymore without any more money.
Hmm. Yeah, I listened to Alex Ramosi is I'm sure you've seen him on YouTube or whatever, and he does private equity, and it sounds like a lot of fun going in there. If you have a specific skill set that your team can apply to a business, finding something that's just for Alex, it's marketing, it's sales that has a bad sales department, and then applying your process to that business sounds like a lot of fun, and I understand the desire there. I'm not quite at the place where it would make sense to leave real estate. But one of these days, I'm definitely going to get on the equity side. That sounds like fun. All right, next question is about. I lost my spot. There we go. It's about lessons learned. Not every deal we get into goes the way we expect it. In fact, many times things go wrong, but we get to learn a lesson there. So, what was a deal that went a little sideways for you, and then what was the lesson you pulled from it?
I think that in the recent history, we saw commercial real estate correct 20 to 30% with 40-year high interest rates. Nobody saw it, not even the institutions. We, a lot of people use bridge debt. So did we in a lot of these deals, and we got hurt ourselves. That said, the other side of it is why would anybody dumbass use this stuff? Well, because you don't have prepayment penalties, and that's how you get in and out of your deal quicker, especially when you have a value add type of project, right? But the problem that we saw is the quickest increase in interest rates in history caught everybody off guard. And that was the thing that, hurt everybody. The notes expired in the worst time where the property values didn't recover
Mm,
in time. So it's very difficult for investors, including myself, in those projects. But the lesson learned is diversify between 4 to 7 years. Dollar cost average your portfolio essentially. We know that there will be a market correction. We absolutely know there will be one. Typically every 5 to 12 years to give you a wide range. Some would say 7 to 8, but we just don't know when exactly that is. So the only way to protect yourself is to just diversify over a time horizon here.
mm. Yeah, that makes sense. You can't. I mean, you can never truly predict the market. You can have an understanding of where it goes, but you can't predict the day that something's going to happen. So, spreading that out over time, spreading the risk out over time, that makes a lot of sense. Would you suggest? I mean, you mentioned bridge debt was a thorn in your side at one point. Would you suggest people not use bridge debt and instead maybe raise more capital, or is bridge debt something that you still are a fan of, just maybe not with tight timelines?
Bridge debt with type timelines is synonymous, right? They go hand in
Right.
hand. I guess I would say like on it depends on the deal, right? Like if you can get in, if you know you can get in and out and you're buying at a huge discount, then fine. So it's very deal specific, but it depends on your risk tolerance, right? Like, take an angel investing deal, you're gonna lose your money 95% of the time, right? In those things.
Yeah.
But
You just got to get in one.
yeah, if the returns are there and you average it out in a large portfolio over time, your average rate of return is going to be, higher than, what than par or your par.
Yeah.
So I think like look, it depends on how you are an investor, and it kind of depends on what floor of the wealth elevator you're at. For me personally, I think I understand the risks. There are a few things in that I am now aware of that I will make me a better investor in the future. But generally speaking, no, I mean, I'll look at it, but it will not be a precluder not to do it again,
Yeah. Makes
you
sense.
know,
It's a tool that
because
you use in
that's how you
specific.
make returns.
Yeah.
Outside returns on the run up, that 5, 6, 7 years up, you make a boatload of money, and then you're ready for it to kind of correct in a way.
Yeah. All right, that leads us to the second to last question, and this is about current today's market. What do you see happening in the next 2 to 3 years? People have been talking about a recession. Do you see that happening? Just where do you see the market going in the next 2 to 3 years?
I mean,
Right now,
commercial.
we can go down to 1 year because we're in such an interesting time. So over the next year, what do you think is going to happen?
I mean, we've talking about like three different market cycles here. Like I'm in commercial real estate, so I know that pretty well. I feel like commercial real estate, we've started to see the bottom of the market. I've seen some of my appraisals come back for way more than it was 6 months ago.
Mm.
Um, those are just one-off data points, anecdotes. Stock market, I don't know. I don't have any stocks. It seems like it's on all-time highs, you know. Hint, hint, hint. But I don't know, right? Like we've detached from reality in the stock market, right? Price to earning ratios just doesn't even matter anymore. Apparently, it's all on what potential it could be. And then residential real estate, again, I'm not in that area, but I've seen in residential real estate, it didn't go through any correction like commercial real estate, which is weird, really, really weird. You're starting to see a lot of in Florida, like a lot of these institutions started to buy the little turnkey rentals, get into the landlording game. You're starting to see weakness in the Sun Belt, Florida, for that type of stuff. What is it that yesterday I put on my social media that I saw that FHA loan defaults are at all-time highs? Maybe
Really
that's an
interesting.
indicator.
Hmm.
Yeah, go Google it. I mean, I was kind of surprised. One of my team sent that to me.
Hmm.
Um, so that at some point there's always a market cycle, as we said.
Yeah.
Buy low, sell high. It's easy to say, but it takes real balls to do it when, like commercial real estate, when it's been beat up and there's blood in the streets.
Yeah. So you do see, and when you say commercial real estate, you are talking about general commercial real estate, not multifamily specific or
Yeah, when I mean commercial real estate, it's office space, apartments, things basically bought without like the residential 30-year mortgages, right? Because that's what created this huge divot in commercial real estate. The lending mechanisms are not on 30-year cycles.
right.
It is on, 1, 2, 3, or under 10-year debt cycles. And that's what created the huge issue in commercial real estate when interest rates skyrocketed.
Hmm.
So people need to understand what exactly triggered this damn thing because well, maybe it doesn't, because it's always going to be something different next time. But it's important to understand what exactly happened so that you can be a better investor next time and know what went wrong, as opposed to just being like most investors, like, well, commercial real estate looks like it sucks, Like, well, understand what is here,
Yeah.
what went wrong.
And you do think we're at the bottom. We've hit the bottom and it's on the upward trajectory.
I mean, at least I've seen data points and adults in my portfolio
Yeah.
to say that. Not to say that, there are a lot of people just holding on, and you know, I think there's some people out there just faking it till they can hold on longer. And at that point, it's just, you don't know. I mean, at some point they're going to have to let go, and that may even crater the commercial real estate even more,
Yeah.
right? But I think we've already kind of see most of the trouble assets go through at this point, and we kind of know the extent of most of it. The nuclear bomb blast went off summer of 2022 into 23.
Yeah.
This is
Okay.
just all the fallout from it.
Yeah. Makes sense. All right, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you, and then what can they expect when they reach out?
They can check out the book, The Wealth Elevator, on Amazon. Like I said, if you want the free PDF MP3 version because you don't know how to read or, lazy like me and doesn't read and
Sitting
likes
in
to
the
do other
sauna, I just want to
things.
put those earplugs in and listen to something.
Yeah, yeah. I mean, maybe you're not like a biohacker and likes to listen to the audio at 3x as you scroll with your finger on the physical copy. But if that's you, yeah, shoot us an email, team@thewealthelevator.com. And if you're a credit investor, reach out. We can certainly chat. But yeah, thanks for having me, Gabe. Appreciate it.
Awesome. Yeah, absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe with realestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week, and we'll see you on the next episode of the Real Estate Investing Club. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.